taxes. Nobody wants to pay more than they have to. And when you get aggravated in tax filing season, you realize there's things you probably could have done to lower that tax bill, but you had to get it done before the end of the previous year. Today we're going to talk about one of those strategies, tax loss harvesting. If this concept is new to you, or if you've heard of it but need to learn more on how it works, then you've come to the right place. Because I'm going to explain to you what tax loss harvesting is and what I hope you find is an easy to understand way. So if you're looking for a tax loss harvesting for beginners video, this video is for you. Welcome to Healthy, Wealthy, and Wise, a channel where we talk a lot about all kinds of ways to improve our financial health, including using strategies to reduce our taxes like in today's video, but also things like health savings accounts and IRAs, as well as general investing types of videos. My name is Kevin, and today we're going to talk all about tax loss harvesting as a way to lower your tax bill. While on the surface it may sound easy, there are some rules if you don't follow, you can completely mess up your whole intention of reducing your taxes and end up paying more. And if you just are looking for the tax benefits of selling at a loss, you could expose yourself to the opportunity cost of not being in the market when future gains could occur. So we're going to talk about all of that today. I want to say first up, if you're someone that invests in stocks and every stock you pick goes up, then you don't need to watch this video. Just do me a solid and push that like button and leave a comment with your surefire picks. See ya. Okay, if you're still here, for everyone else, I'm assuming you occasionally have some stocks that are underwater from where you bought them. Me too. Well, today, by discussing tax loss harvesting, I'm going to tell you how you could use those stocks to help counter the gains you realized from the stocks you sold for a profit to help reduce your taxes, but to still keep your investment portfolio strategy on track by keeping you invested in the market. As we get started, please remember, I'm not a financial advisor and I'm not making any recommendations on whether you should or shouldn't use tax loss harvesting. The purpose of the video is to help give you a better understanding of what it is, not to tell you what to do. You should always do your own research or consult with your own financial advisor or tax professional when making any investment decisions. Alright, tax loss harvesting. What is it? Well, right off the bat, it's a strategy of selling a stock at a loss to offset a capital gains tax liability, or basically the gain from another stock you sold at a profit. So as you probably already know that when you sell a stock at a higher price than you paid for it, you then have to pay a tax on the gain of it. So if you bought a stock for a total of $1,000 and then sold it for $1,200, you would have to pay a tax on the gain, which is $200. Now that tax can vary depending on how long you've owned the stock. If you owned the stock for under a year, you would pay a tax at the short-term capital gains rate, which equals your normal income tax rate. So if you fall into the 24% tax bracket, you would pay a 24% tax on your short-term capital gain. So in our example, the $200 profit you made on selling the stock would get reduced by $48, so your true profit would be $152. The purpose of this video is to show you how you can legally lower that tax bill. But before we get into that, just to see the difference, let's say you held the stock for over a year. In this case, you would have to pay a long-term capital gains rate that is less than the short-term capital gains rate. This rate will vary based on your income, but it could be either 0%, 15%, or 20%. You can see in the screenshot how this is determined based on your income. Most likely, back to our example of someone in the 24% income tax bracket, your long-term capital tax gains rate would be 15%. So to see the difference on our $200 tax gain from our example, your tax liability on a stock that you held for longer than a year would be $30, which of course is less than the $48 you would owe if you held the stock for under a year. And if you do the math for this example, the long-term capital gains tax would be a reduction from the short-term gain rate of about 37%. So considering the preferential tax treatment of long-term gains and your timing on when to sell could be important for your taxes, but that's not the purpose of today's video. Capital gains rates might be something you're already familiar with, but knowing which stocks are falling in either short or long-term capital gains will be something you have to be aware of when we get more into the decision-making with tax loss harvesting. But let's not jump ahead. First, let's talk about capital losses. Those stocks you sell at a lower price than you paid for. So these are your losers. But they can help you lower your tax bill because you can take your losses and offset gains you made from other stocks you sold or your winners. So let's add to our example. Let's assume you bought a stock with $1,000 and sold it for $850. leaving you with a loss of $150. When taxes are due, you could use that loss to offset the $200 gain from the first stock that we talked about. Now keep in mind that the IRS requires you to offset gains with the same type of losses first, meaning that if you have a short-term loss, it's used to offset a short-term gain, whereas if you have a long-term loss, it's used to offset long-term gains first. After you prioritize that way, and if you still have more losses than gains, you can apply the difference to gains of a different type. So in some cases, you could use long-term losses towards offsetting short-term gains. So anyway, we're using our $150 loss to offset our $200 gain. If both stocks were held under a year, that would leave us with a short-term capital gain of $50, 200 minus 150. And the tax due on a short-term capital gain would be $12. Again, assuming that you're in a 24% income tax bracket. So that would reduce your tax liability at $48 down to $12. Now that's the part that's good, but that's not what tax loss harvesting actually is. Yes, you lowered your taxes, but when you sold your stock at a loss, well, you captured or realized your loss, which means you lost money. So in our example, that was $150. At most, again, assuming that you're in the 24% tax bracket, that would potentially lower your taxes by $36. Not apples to apples. So selling a stock at a lower price is always a loss. Using it to offset a gain just makes it a little easier to swallow. But this is where the concept of tax loss harvesting can help take some of the bitterness out of your mouth. Because the other issue is that when you sold the stock at a loss, you remove the potential for you to make money if that stock was to go up in the future. So the idea is you sell your stock for a loss, but then you take that money and put it right back into the market. And when you do that, you replace with a similar stock or asset to maintain a similar exposure of expected risk and return levels. Notice how I said similar and not the same. What you can't do is sell your stock for a loss for the purpose of reducing your taxes, and then immediately buy the same exact stock again. This is called a wash sale, and if you do it, you lose all of the tax benefits of doing it in the first place. So I'm going to put up a screenshot from Investopedia which explains the nuances of this in a pretty easily understandable way. So as you can see, a wash sale occurs when an investor sells a stock or other security at a loss, and within 30 days before or after the sale, and buys substantially identical stock or securities, acquires substantially identical stock or securities in a fully taxable trade, enters into a contract or option to buy substantially identical stock or securities, or acquires substantially identical stock for an individual retirement account or Roth IRA. So there's a lot to unpack here. So let's talk about some of this. The first thing is the last point. So with tax loss harvesting, this strategy is used for your taxable investing accounts. So you're not doing this within your 401ks and IRAs because your gains there are tax deferred. But what this last bullet point says is if you sell a stock for a loss in your taxable account, you can't then go and buy the same stock for your IRA. Because let's face it, when you hold a stock, you generally expect it to go up. So if you sell it for the purposes of tax loss harvesting, you're capturing that loss, and if the stock goes up after you sell it, well, that doesn't feel good. So if you think you can get around that by selling your stock at a loss in your taxable account and then buying it in your non-taxable account, well, you can't, because then you have a wash sale and you can't use that loss to offset gains, which was the whole point of selling it in the first place. So let's talk about the 30-day rule next. You can't buy the stock right after you sell it and be able to use it to reduce your taxes. I don't think a rule like this should be surprising because the IRS wants their money and they don't want you to game the system where they don't capture the revenue they think they should get. So for you to get the tax benefit, you have to be willing to potentially lose out on potential gains over the next 30 days. Now on the other hand, say you think you can be clever and buy more of the stock before you sell the shares you've already had, therefore keeping you invested. Well, you can't, because the rule also says you can't buy the stock 30 days before you sell it without it being considered a wash sale. So really, it's not just a 30-day rule, it's more of a 60-day rule or window where you can't buy more shares of the stock 30 days before or 30 days after the date you sell it for a loss. Now, just one extra point that some of you may be wondering. The wash sale 30-day rules don't apply to stocks you sell for capital gains, because in this case, the IRS is getting their money, so they're happy. Now another thing. Let's talk about the first bullet where it mentions a substantially identical asset. So what did that mean? While there's not a concrete black and white definition from the IRS, basically it means that the security is not really close to what you just sold. So let's say you sold a Vanguard S&P 500 ETF and then bought another Vanguard ETF that tracks the S&P 500. That while a different fund, it was pretty similar. That could be considered a wash sale and you could not use this for tax loss harvesting. Now if you sold that Vanguard fund for a Fidelity ETF that also tries to track the S&P 500, most likely because it's a different company with different managers, it would not be considered a wash sale. For individual stocks, if you buy a company that is not the same exact one, or a reorganization of the same company, you would be good to use it for tax loss harvesting. So let's take two examples to show you how tax loss harvesting works to reduce your taxes, but still keeps you invested and therefore your investment portfolio on track. The first example is the one I just mentioned about the ETFs, selling a Vanguard one and then buying a Fidelity one. Because you sold the Vanguard one at a loss for tax purposes, you then took the money out of the market, putting you at risk for missing out on future gains. But because you then buy the Fidelity fund that also tracks the S&P 500 just like the Vanguard one, you could expect that the Fidelity fund would have similar performance and market risk as to the Vanguard one. Therefore, you're still invested and maintain the potential of future gains. Now another example is using individual stocks. So let's say you feel semiconductors is an area that you think is going to outperform the overall market. But you also have Intel, who is currently at a loss right now. So what you could do is sell Intel, but still keep your exposure to semiconductors by buying an ETF that holds semiconductors, or buy stock from a single company like AMD. That way you're still keeping exposure in semiconductors, but still getting to use that capital loss from Intel to reduce your taxes. And you could use this in other sectors, say Coke and PepsiCo or Delta and Southwest. You get the idea. It's just a way for you to sell your stock, but staying invested in a sector that you feel will go up and avoiding a wash sale. Tax loss harvesting. You can do it at any time of the year, but a lot of people tend to utilize the strategy at the end of the year as they look at what they already sold that resulted in gains. December. 'Tis the season for gifts, and I have an idea for you guys if you stick around for a little bit longer. And for tax loss harvesting. What I do, and something you might want to do, is put a notification in your calendars to remind you to look at your realized gains and losses near the end of the year, and have it set to repeat yearly. Now something else to consider just for capital losses in general, if you have more realized capital losses than capital gains in a year, you can use the extra losses to lower your overall income by up to $3,000 for tax purposes. And then if you had additional losses, they can get passed on to lower your taxes in future years. While we're talking about lowering your taxes, remember to also look at fully funding your HSAs and IRAs. The nice thing about those two ways to lower your taxes is that you can do this into the following year up until the tax filing deadline. You can't do that with tax loss harvesting. Got to do that by the end of the year. Now we've talked about IRAs and health savings accounts before, so be sure to check out some of my other videos on them. I'll link some of them for you in the description. So what do you think? Have you used tax loss harvesting before and have something extra to share or something I might have missed? Please add that in the comments for everyone to see. And if you like this type of video, give me some feedback there too. That way I know to make more videos like these. Or just push that like button. That helps me as well. And remember to share the video with your friends on your social media sites so that you can help them out. You know what I would do too? Give them a holiday gift for a free subscription to the channel. Just give them a link and tell them to hit the subscribe button, and it won't cost them a cent. You'll come out looking good for the gift, and you'll have yet found another way to save money by watching this channel. Alright, anyway, if this was your first time watching one of my videos and you stuck around this far, definitely consider subscribing. Again, it's totally free, and along with turning your notification bell on, it's the easiest way to make sure you don't miss any upcoming videos. And one more thing, if you're interested in seeing some of my non-financial type of videos, I hope you check out my new second channel, How To with Kevin, where I show you other types of things I've learned to tackle. It's been a lot of different things so far, and I could definitely use your support by getting the subscriber numbers up on that channel as well, as we're just starting off. Thanks so much for watching, and until next time, have a great day.